Hello, and welcome to the Venue Coach Blueprint for Owners. I'm Kyle Labar. This podcast is all about helping you fill your wedding venue with more bookings, earn more from each one, and keep your customers happy for a long time. We'll also talk about some tough times and big lessons that I've learned along the way. Let's dive in together and make your venue the best spot for weddings. Hey everybody, welcome to another episode of the Venue Coach. Today I wanted to just share a little bit about our process that we're going through to get our loan refinanced. If you're anything like us when you first got started, if you aren't one of those venue owners that happen to own the land for a long time and just finance the build of your venue yourself, but instead you saw an opportunity and decided to take out a loan. This episode is for you. Now you have a loan, and you probably got an SBA loan like I did, and you are probably feeling the pains of having 11% interest or somewhere near that, 10% plus, like I am. And here's what we're doing to try and bring that down. So the first consideration is usually with an SBA loan, you have a prepayment penalty for the first 3 years. It diminishes. So within year one, it's 5%, then 3%, and then 1% on the third year. After 3 years, no penalty at all. So for our venue, um, we are at like 11% on the interest, and it's insane. I hate it, but we saw the opportunity. We knew it was good, and so we took it anyways, knowing that that was the risk. And now we are trying to get out from under that one and get it into a lower rate, like a 7%. We also self finance slash private financed our chapel build, and so we're trying to get that rolled into one, basically get it all into one single payment. And the the big thing for us that we've noticed at 7% is we're able to bring our loan down where we can save like $7,000 a month. So this one's huge. It's like getting one or two extra bookings for your venue without having to get one or two extra bookings for your venue because you're just reducing your costs. So this is one of the biggest cost reduction things that you can do if you have a high interest or higher interest on your mortgage, to bring down your costs and increase your profitability. So the big things that the banks are looking for, they want to see that you're actually profitable, that you're actually producing, that your cash flow is good, that you have a good LTV, so your equity, which if you already have the loan, you should be fine on that, but they want to see your DSR, which is your debt service ratio, and typically they want you to carry about 25% more than what they require on the mortgage in in your cash flow. So meaning, or in your profitability. So meaning, if your mortgage is $10,000, they want you to be making 12,500, and that's after expenses, right? So you, after all of your expenses, your fixed costs, your cost to fulfill, how much you have left over, that's what you have available to pay the mortgage, and they want that number to be 25% higher than the note of the loan. And the great thing is, if you're refining and you're already able to pay your mortgage currently, then you should be fine on this as well, because if you're able to pay the higher rate, then when it comes down, you'll be even more able to pay that. So you just have to talk with a bigger lender. Some of the smaller lenders are like, "Oh, we don't understand this industry and we don't know what we're talking about." So you talk with a bigger lender, ones that are able to bear a little bit more of that supposed risk, and then you're able to go through it. Now there's conventional loans, there's other SBA loans that can lock you in for 5 to 10 years at a certain rate and that sort of thing. And so it really just depends on you and the bank and the loan officers and all of that to get it sorted out. But once you do that, then it's just like when you got it the first time. You submit all your paperwork, you give them all the documents, you say, hey, this is whatever, and then they collect all the information, send it to underwriting, do an appraisal, and then, hey, we can do this. So that's the process. Don't be afraid of it. Like, you've already done it. If you've already gotten the loan, you've already done it. But you should be looking at that, especially with the rates announced. Like they're pretty much announcing that they're going to drop in the next month or two. It'll probably go down by a 1/4% if we're lucky, and so it won't go down by much. But we're seeing rates go like we can get locked in for a 7%, where before like right now we're at 10 or 11, and so that's a huge savings, especially for some of your venues. You know you got a 3, 4, $5 million place. That's huge. That's thousands and thousands of dollars every single month that you can put back into your pocket, and actually uh, maybe pay yourself, maybe hire somebody to come in. You can do a lot for the business if you aren't being eaten alive by the interest rate. So, anyways, don't be afraid of it. Just do it. And the one thing that we always do is we want to make sure that the bank is never waiting on us. So whenever they ask for things, we just send it back to them as quickly as we can, and then we put the ball back in their court. So, anyways, I hope this helps. Just wanted to share that experience what we're going through, and hopefully we should get through this process in about 2 months, and then we can start seeing the savings from there. So, anyways, if this was helpful for you, please subscribe and stay tuned for the next one.